In the summer of 1934, a quiet notice appeared in several European papers. It stated that a group of major nations would stop paying certain war debts owed to the United States. The announcement was brief, most people never saw it. Yet billions of dollars that had been promised simply vanished from the schedule. The world moved on as if nothing had happened. What made the moment unusual was how normal it felt to the governments involved. Large powers had walked away from their obligations before. They would do it again. The public rarely heard the full story. A retired accountant in London later recalled watching a neighbor fold the newspaper and shake his head. He reportedly said that ordinary people always had to settle their bills. Big countries seemed to follow different rules. His comment captured a small truth that still echoes today. This topic matters because debt is not just numbers. Debt shapes trust, it shapes trade. It even shapes how nations treat one another. When a major power refuses to honor a promise, the ripple can travel through banks, markets, and households far from the original source. You may have wondered why some governments face harsh pressure when they fall behind while others appear to slip away quietly. There is a pattern behind this behavior. It has appeared many times across the last century. And once you see how it works, the modern financial world looks different in a very simple way. What happened in 1934 was not the first example. It was only a small window into a much older habit that powerful nations rarely discuss in public. So let us walk back to the moment where this pattern truly began. The story begins long before the debts of the 20th century. It reaches back to the early 1800s, when several European empires borrowed heavily to fund wars and colonial expansion. The numbers were large for the time. Britain reportedly carried more than 200% debt to its annual income after the Napoleonic Wars. France and Austria followed similar paths. Yet these burdens did not crush them. They simply adjusted the rules that governed their repayments. Many historians point to a quiet practice that emerged during this period. Powerful governments learned that if they controlled trade routes and influenced lending markets, they could stretch their obligations for decades. Some loans were refinanced so often that the original terms faded from memory. A few were quietly written off by sympathetic creditors who depended on the empire for business. Small nations did not enjoy this treatment. They were expected to pay in full and on time. One old letter from a Dutch banker describes a dinner in 1817. He wrote that a British official smiled while explaining that the empire might take a generation to settle certain accounts. The banker noted that the official spoke as if this were completely ordinary. The tone of the letter suggests that no one at the table questioned it. Have you ever noticed how some rules seem flexible for a few but fixed for everyone else? This early habit set the foundation for a quiet playbook that would grow stronger over the next century. And the next shift in power made the pattern even clearer. The first clear shift in power arrived after the First World War. Between 1919 and 1923, governments across Europe signed repayment schedules that looked strict on paper. The United States was listed as the main creditor. The total amount owed exceeded $10 billion at the time. It was presented to the public as a firm obligation. Behind closed doors, the tone was different. According to archived records, several officials viewed the debts as political tools rather than fixed promises. Payments were delayed almost immediately. Deadlines were extended. Interest terms were quietly adjusted. Ordinary citizens were told that discipline would return once stability improved. A French civil servant later recalled reviewing balance sheets that never seemed to settle. Each year, the numbers shifted slightly. He reportedly noticed that the strongest countries negotiated delays while weaker ones faced penalties. No announcement was made. It simply became the accepted order. The year 1931 marked a turning point. Germany suspended major payments. Britain followed with its own adjustments. Within 3 years, several governments had effectively stopped paying in full. The system bent without breaking. Did it surprise you that these decisions happened with so little public debate? What insiders understood was that power now shaped enforcement. And once that reality set in the financial world would never return to its earlier rules. The hidden mechanism was not a single law or treaty. It was a system built quietly inside financial institutions. Central banks sat at the center of it. They controlled credit, currency access, and emergency support. This gave powerful nations room to maneuver when payments became uncomfortable. During the 1920s, coordination increased between major lenders. Officials from the Bank of England met regularly with counterparts from the Federal Reserve. These meetings were rarely publicized. According to insiders, the discussions focused on stability rather than strict repayment. If enforcing a debt threatened trade or markets, the pressure eased. One practical illustration appeared in currency policy. When a strong nation faced payment trouble, its central bank could loosen credit at home. Money became easier to borrow. This reduced political tension. At the same time, creditors were encouraged to accept delays for the greater good. Smaller nations did not have this option. They relied on external approval to access funds. A former clerk in Geneva recalled watching delegations pass through the offices of the League of Nations. He reportedly noticed that large countries arrived with confidence. Their requests were framed as necessities. Others arrived apologetic. Their requests were framed as obligations. Have you ever wondered why some debts are treated as negotiable while others feel absolute? This mechanism operated quietly for years. And as global finance expanded, its influence only grew stronger. The consequence nobody expected arrived slowly and quietly. By the late 1930s, several large debts still appeared on official books. In practice, many were never fully collected. According to Treasury summaries from the period, less than half of the original World War debts to the United States were ultimately repaid in real terms. The numbers faded through inflation extensions and partial settlements. Inside government offices, reactions were reportedly calm. Officials spoke of realism. Some described the losses as the cost of leadership. Publicly, the language remained firm. Privately, expectations had already adjusted downward. An American schoolteacher in Ohio later described paying higher local taxes during the Depression years. She recalled reading that foreign governments were struggling. She reportedly assumed that everyone was sharing the burden. She did not know that many obligations had already been soft or deferred far beyond public promises. At the same time, smaller countries faced a different reality. Those that missed payments encountered currency pressure, trade restrictions, or loss of credit access. The contrast widened without announcement. Did anyone tell ordinary citizens that the rules had changed? This quiet outcome reshaped how nations thought about promises, and it prepared the ground for the next stage where debt would no longer be treated as a moral issue at all. The escalation began after the Second World War. The scale of borrowing expanded beyond anything seen before. Governments financed reconstruction armies and social programs at the same time. Debt totals rose into the hundreds of billions of dollars. Yet enforcement grew even softer for those at the top of the system. In 1944, new institutions were created to manage this pressure. The International Monetary Fund and the World Bank were presented as neutral referees. Their stated goal was stability. According to insiders, stability often meant keeping major powers liquid, even if debts were rolled forward repeatedly. When a large nation faced trouble, new credit lines appeared. Deadlines were extended. Terms were reframed as cooperation rather than rescue. Smaller borrowers faced detailed conditions. Budgets were reviewed. Spending was cut. Taxes were raised. A shipping manager in Italy recalled the late 1940s. He reportedly noticed that fuel prices and port fees were rising at home. Foreign headlines spoke of recovery and partnership. Locally, the strain felt very real. Have you noticed how debt can feel invisible at the top but heavy at the edges? As decades passed, this pattern hardened. Debt was no longer something powerful nations feared. It became a tool they learned to manage. The breaking point arrived in August 1971. On a quiet weekend, the United States made a unilateral decision. It suspended the dollar's convertibility into gold. This ended a promise that had anchored the global system since 1944. The announcement came from the White House with calm language. Officials described it as temporary. Markets understood it as permanent. From that moment, debts tied to fixed values became flexible by design. The key pressure point was confidence. Foreign governments held vast reserves of dollars. They trusted that those dollars meant something stable. Once that link was cut, repayment no longer required a fixed measure. It could be met with newly created money. A European central bank aide later recalled watching the exchange screens that week. Rates moved quickly. Phones rang without pause. He reportedly noticed that protest was muted. No major creditor challenged the decision directly. The institution at the center of this moment was the United States Treasury, supported by the Federal Reserve. Together, they controlled the currency most debts were written in. That control changed everything. If a promise can be rewritten by the issuer, what does repayment truly mean? After 1971, the system did not collapse. It adapted. And in that adaptation, the power to delay, avoid, or reshape debt reached its modern form. When everything is placed side by side, one pattern becomes clear. Debt enforcement has always followed power, not principle. Those who control currency, trade, access, and institutions shape the outcome. History shows this repeating again and again. In the 1800s, empires delayed repayments through influence over lenders. After the First World War, major nations negotiated softness while weaker states were disciplined. After 1944, global institutions preserved stability by protecting the largest players. After 1971, currency control removed the last hard boundary. The pattern is simple. If a country issues money, others depend on its debts become flexible. If a country depends on money it does not control, its debts become strict. The difference is not morality. It is leverage. One former official at the International Monetary Fund reportedly described the system as asymmetric but necessary. He said enforcement followed what could be enforced, not what was written, not what was promised. This explains why similar debt levels produce different outcomes. A large economy can refinance indefinitely. A smaller one must adjust quickly or face consequences. The rules appear neutral. The results are not. Have you ever wondered why history keeps forgiving the same players? Once this pattern is seen, it becomes hard to ignore. And it leads directly to how today's world was shaped by these quiet choices. The long-term consequences are visible in today's financial landscape. Major economies now carry debt levels that would have triggered crisis a century ago. Japan's government debt has exceeded 200% of its annual output for years without default. The United States has passed $30 trillion in federal obligations. Markets continue to function. This endurance is not accidental. The debts held by powerful nations are often owed in their own currencies. They can refinance through domestic buyers. Central banks can intervene during stress. What once looked like risk is now treated as normal. Smaller countries experience a different aftermath. When growth slows or export prices fall, pressure appears quickly. Access to credit tightens. Currencies weaken. Conditions are imposed to restore confidence. The same system that absorbs shocks at the center transmits them outward. A factory owner in Southeast Asia described cutting staff after interest rates rose abroad. He reportedly did not borrow from foreign governments. Yet global debt decisions shaped the cost of his loans overnight. The chain stretched farther than most people realized. This pattern has also reshaped politics. Public debate now focuses less on repayment and more on sustainability. Debt is discussed as something to manage rather than something to eliminate. For large powers, this shift brings flexibility. For others, it brings dependency. Do you feel that debt today connects distant decisions to everyday life more than ever before? The echoes of past choices still move quietly through markets, institutions, and households. And understanding them changes how the present moment looks when placed in context. The final frame is not about blame. It is about understanding how the system actually works. Major powers do not escape debt by accident. They shape the environment in which debt exists. Across history, the same tools appear. Control over currency, influence over institutions, the ability to delay without consequence. These tools turned repayment into a choice rather than a rule. A familiar echo can be found in the aftermath of the 1970s. As inflation rose, debts lost real weight. Promises remained on paper while values shifted quietly. Those issuing currency absorbed the change, those using it felt the loss. One former advisor at the Bank for International Settlements reportedly summarized the reality in private meetings. Debt, he said, was never erased. It was transferred. Time, inflation, and policy decided who carried it. This meaning is easy to miss because the system rarely announces itself. There are no headlines declaring forgiveness for the powerful. There are only adjustments, extensions, and reforms. Each one sounds technical. Together, they reshape outcomes. So the question is not why some debts remain unpaid. The question is who has the power to decide what payment means. Once that is understood, the financial world feels less confusing. And the quiet logic behind past and present decisions comes into clearer view. At the end of this story, the system feels less mysterious. It also feels more human. Decisions made far from public view shape outcomes that last for generations. Most people never vote on debt policy. They live with its results. Prices change. Jobs shift. Promises feel firm or flexible depending on who made them. Understanding this pattern does not require anger. It only requires attention. History shows that rules often reflect power more than fairness. Seeing that clearly can bring a quiet kind of clarity. As you think about the world today, you might notice these choices playing out again, in headlines, in markets, in everyday costs that seem to arrive without explanation. What part of this story felt most familiar to your own experience? If you enjoy stories like this that explore history, finance, and quiet patterns shaping our lives, you may wish to follow along for future discussions. Thank you for spending this time together.